I have analyzed 25 dividend stocks in the upstream sector with you. Today marks the conclusion of this playlist, so to speak. I will go through all 25 dividend stocks that I hold with you once again, briefly mention 2 important points about each, and provide you with the key information regarding them. The average dividend yield here for me is about 7.2%, up to a maximum of about, with equipment draw, in some cases up to 16%. I would say let's just get started and dive right in. As you know, I hold stocks. For example, Chevron and TotalEnergies, all the way down to microcaps like PetroTal in the Peruvian jungle. We'll go through them group by group first. That means majors, Norway, UK, North Sea, North America, and emerging markets. And APEC and also others, as I mentioned, have already paid dividends, and currently my rating would say. So let's just get started, as I already mentioned. Let's start with the majors, specifically with Chevron. Yes, with a current dividend yield of about 3.6% and a P/E ratio of 30. Chevron is indeed the quality pick, but also simply the most expensive in the sector. The Hess acquisition will bring the Guyana stake fully into the cash flow by 2026, and it has the lowest dividend in this series here. This means that here you simply have, let's say in quotation marks, a safe dividend stock that tends to have less volatility compared to other small caps, so to speak. So a very established company, ultimately. Let's move on to ConocoPhillips. And here we have a dividend yield of about 2.65, a P/E ratio of 15.8, and about 17 years of reserves. Goldman has put it on conviction and delivered double the synergies at Marathon. The Willow project in 2029 will bring an additional 4 billion in free cash flow. This is basically the best in the PD series. Here, I would possibly buy more at around 110 euros. As I said, yes, for me. A dividend yield of about 2.65%, so not the highest here either, but still an established company. Now let's move on to TotalEnergies. Here, we currently have a dividend yield of 4%. A forward price to earnings ratio of 11.1 and a net income of 15.6 billion. And this is the best European major in the LNG business, with an expected increase of 50% by 2030. Master Renewables stands at $2.2 billion. Dividend growth averages 9% per year. Currently, it is fairly valued. Now let's move on to BP. Here we currently have a dividend yield of about 3%. However, we also had a quarterly loss of 3 billion in 2025, and buybacks were suspended for the time being. BP had write-downs of 2.5 billion in the renewables sector, quarterly loss of over 3 billion. Share buybacks have been stopped, and 2026 will have to show whether the new strategy is effective. Currently, as far as I have heard, just briefly, I haven't gone through all the details yet, but as far as I know, they have currently doubled their profit. So that's actually good news as well. And BP had been punished by the market the whole time. And if you can get in at a good price there, it's definitely worth considering. Let's move on to Eni, which offers a dividend yield between 6 and 8%. Here, the focus is on the LNG sector. Eni is positioned differently than Shell or BP. Here we have a clear focus on gas and LNG, with projects in Mozambique, Congo, and Egypt. It's a cash flow machine well into the 2030s. Here we have a solid major with an above average dividend yield. Now let's move on to Repsol. Here, the dividend yield is between 8,000 and 10,000 euros. And 10%, this is an integrated up and down plus low carbon. Repsol combines upstream cash flow with refineries and unibills. High dividend yield, fair value with energy transition optionality. Now let's move on to the Norway sector. Here we have, among others, Equinor, Norway's state giant. Here we have the lowest break-even costs in Europe, a robust balance sheet, and again, renewables optionality. In 2026, we had stable production and a high cash return. The current dividend yield here is around 7% and also North Sea dominance. And with offshore wind optionality, as I already mentioned. Now let's move on to Aker BP. Here we have a dividend yield of 9%. Here we are only in the pure upstream sector. And here a free cash flow boom is expected starting in 2027. Here we have one of Europe's most efficient E&P players. No refineries, just production. Low costs, high dividend, a free cash flow wave in 2027 when new field years ramp up. So for dividend investors looking for a higher dividend, this could potentially be a supplement. Now let's move on to Var Energi. We currently have a dividend of 12%. With 397,000 barrels of oil equivalent per day, a P/E ratio of 12.7, and a free cash flow of over 2 billion. Norway's number 2 behind Equinor in terms of content. Production was doubled here in 2 years, 12% dividend covered by free cash flow. And currently we have a 60% payout here. Now let's move on to the Oasis. A somewhat smaller position for me. At the moment, I have a dividend yield of 9.5% with 110,700 barrels of oil equivalent per day. We have a deal here that has transformed the company. Now 60% is OECD, meaning North Sea, and 40% is Kurdistan. Revenue for 2025 has been doubled here. The valuation is still absolutely absurd at the moment, cheap with a P/E of 5. So here too, it would be an option to simply take a look at the whole thing. As I said, it's not yet an established company, but you can certainly consider it as a small addition. Also, just take a look here in general. Where might there be a buying zone here that I would like to buy in, or do I not want such strong fluctuations? And do you set it aside? After the majors, let's move on to Var Energi, which pays a dividend of 7.5%. Here, we're in the area of African assets and have stable production. So it's a Norwegian small cap with cash flow from Africa, Gabon, Tunisia, Equatorial Guinea. And here we have low break-even points and project timelines that can be planned out into the 2030s. Here we currently have a hidden gem for the patient investor. That means the company is still somewhat in a building phase, among other things. I've already provided plenty of information about this. Feel free to check out the individual video series here as well. Now let's move on to Block 3 and the UK North Sea players. Here we have, among others, Var Energi with a dividend yield of 6.8%, a P/E ratio of 4.2, and a free cash yield of 18.3. The payout here is only 28%, and this is the UK's largest independent oil producer. A P/E of 4.2 is therefore also very cheap at the moment. As mentioned, the payout ratio is only 28%, so the dividend is massively underdistributed with a buffer. A fair value plus 49% upside is now added to that. Serica Energy has a dividend yield of 5 to 6% and an EV/EBITDA of under 2. 4. Acquisition in 2025 brought in at $3.30 per barrel. Production doubled to 65,000 barrels of oil, equivalent by the end of 2026. However, the UK Energy Profits Levy with a 165% tax rate reduces profits by 1 billion. Tax assets are missing from then on. The value with a clear catalyst. Now we come to energy, which is a bit more complicated, especially with Israel and so on. Here, you definitely need to take a closer look at how the situation develops. After all, I have a dividend yield of 10.2% here with 154,000 barrels of oil. Equivalent gross, and currently, as I already mentioned, the carriage field is offline. We currently have debts amounting to 3.2 billion. However, Q4 shows operational strength. The Catalan project in 2027 is expected to bring growth. And the Israel risk, of course, remains very real. So at the moment, it's probably more of a small addition. Currently, it's considered more of a speculation. Until you know how things develop, or you might even leave the position out entirely. Now let's move on to North America, and here we have Devon Energy. Here we currently have a dividend yield of 5%, a free cash flow yield of 10%, and we also have the Coterra merger. It's a shale king from the Permian, net debt to EBITDA below 1. We have capital expenditure discipline, a 5 billion buyback program, and the Coterra merger brings additional scale. So currently this is a solid US stock. For now, we'll see what the merger will bring in the future. Now let's move on to AP Corp, where we have a dividend yield of 3.5%. Formerly Apache, spin-off, and currently we have a low valuation. This is purely an upstream player, not a major, stable free cash flow, a low valuation, but currently no clear catalyst. Personally, I'm holding because I got in at a favorable price and now I'm just letting it run. With oil prices, let's move on to Riley. Here, over time, we have a dividend yield of 4.4% and a PE ratio of 4.9. And here, the payout ratio is only 20%. This is currently a Permian microcap with a rather low valuation. We also currently have sufficient buffer, and Bobby Riley holds 14% of the shares, which means, so to speak, skin in the game. That means... Now let's move on to in-play, where we have a dividend yield of 6 to 8%. Currently, they pay monthly. Here, we have 17,000 per lift per day and a reserve life of 17 years. So not lift, of course, the remaining reserve life is currently 17 years. Cardinal Bertha doubled production. Leg currently holds 32.7%. Now let's move on to Cardinal Energy, where we have a dividend yield between 7 and 8%. Alberta, Loss, Saskar, Stewart. And here we have a solid free cash flow. A Canadian mid-cap with stable free cash flow, low operating costs, and a predictable reserve base. And with falling oil prices, we have a thin margin here, and you should be aware of that. As I said, I have explained all of this in great detail in the individual videos. Feel free to check them out. I usually mention the break-even point as well, so you can always see exactly when a stock, let's say, has massive free cash flow available in order to pay out dividends. Let's move on to block 5, which is about emerging markets. And here we have, among others, of course, Petrobras with a dividend yield in the double digits, a free cash flow yield of 18%, a PE ratio of 6, and plans for $109 billion in growth in Brazil's pre-salt fields with lifting costs under $6 per barrel. And those are frankly absurdly high margins. 8% dividend, a $109 billion investment plan through 2030. But of course we still have political risk here, and then we also have Ecopetrol with a 16% dividend yield and a PE ratio of 8.3. And here we definitely need to keep the 2026 election in mind. This is, so to speak, the highest dividend in the entire series, namely with 16%. But Colombia has presidential elections in 2026. A left-green Petro successor could cut oil production. A coupon clipper with political dynamite here. So you simply need to be aware of that and keep it in mind. Now let's move on to PetroTal. Currently we have no dividend here. It has actually been suspended. We have a P/E ratio of 3.5 and reserves of $1.7 billion. So again, a P/E of 3.5. Reserves are currently valued at 70% below book value, which is actually very, very cheap right now. But the dividend was suspended here in November. Production in 2026 minus 40%. And everything is transported by river barges through the jungle. So here we definitely need to take a look at the Q1 earnings. They will be released on the 19th of March. I know, unfortunately, I can't cover everything when new quarterly reports come out. I'm always in any case up to date. I know what's happening, but I can't always make videos about it. That's why, of course, there's also the option that I could develop this accordingly and post it somewhere as an article if you want. Alternatively, there's the option that I post the whole thing on my website. Or alternatively, that I even send out quarterly reports via newsletter, that I start a second newsletter and maybe create a newsletter specifically for voting shares. Because I just want to say here that I'm quite well invested, maybe also in the shipping industry, but I would actually only do that if there is genuine interest. I mean, I also still have a full-time job at the moment, which means unfortunately I can't completely always update all the quarterly reports for you right away as soon as something comes out. Unfortunately, I can't do that yet. If that ever becomes possible, of course I would be happy, and then it would happen accordingly, but at the moment that's just not feasible or realistic. Now let's move on to Total Gabon. $793 million in cash with a market capitalization of $1 billion. Enterprise value is practically zero. Here we have an 8.5% dividend and it's covered 3 times over by free cash flow. Production is declining by 6% per year. And here we also have a nationalization risk in Gabon. As I said, that's definitely something you should be aware of. I think I just got a bit sidetracked or drifted off. You definitely have to let me know in the comments how you want to handle this. Should I write it on my website for someone? Should I make community posts? Or should I set it up for you in 2 newsletters? Just let me know. I'm also happy to summarize it for you and what kind of impact all of this finally has. Yes, please let me know in the comments. So now let's move on to block 6, namely the EPEC, that is the other values. And among others, they still have Var Energi with a dividend yield of 6.5%. And here this is an LNG giant, namely Australia's LNG king. Scarborough Pluto Train 2 will start in 2026, and that brings production and high capex, but also long-term LNG contracts to Asia and current LNG exposure for the portfolio. Currently, the stock is fairly valued. Although, to be completely honest, I have to say, according to fundamental data, it is fairly valued. Personally, I base my decisions both on fundamentals and technicals, but I want to have a technically favorable entry point. That means, personally, I am currently not buying any upstream stocks. The only thing I have added recently is Kraft. Recently, it was Central Eco Metals, because it actually dropped below my entry price. But otherwise, at the moment, most things are just on my watch list, so to speak. So then we also have OMV, and here my dividend yield is 6.5% with a gas share of over 50%. And here we have Neptune, Deep Romania 2027. And this is Europe's most important gas upstream player. Neptune Deep Romania will start in 2027. And this is expected to bring in billions more in cash flow. And that's just one example. Here too we have an exceptional dividend history, and the company is comprehensive, which is strategically important for Europe. And then we come to Horizon Oil. Yes, over time, a dividend yield of 12%, which currently is not sustainable. We have 5,000 barrels per day and a payout ratio of over 300% at the moment, as I already mentioned. A 12% dividend sounds like a dream until you look at the 300% payout ratio. P&G has 290 million barrels of gross reserves, but for now, I would wait until the payout ratio finally normalizes. Alternatively, you can also check out the last video on Horizon Oil. I have to admit, I don't really remember exactly what I said back then, but it's actually just a small position. But if you're interested in the stock, feel free to take a look. As I said, it's a smaller holding for me. Just take a look if you like. Otherwise, I'll probably do a quick rundown now. It's an entire table in the end. There you can see everything again, including the region, the stock, dividend, yield, so to speak, and also the rating is included, whether it's buy or hold, etc. Of course, the value is not investment advice, but rather what all the rating agencies or banks are passing on as ratings. I've simply included that here as well in the end. As I said, there are a total of 26 positions, actually. We currently have an average dividend yield of 7.2%. That's basically it. That's the current situation, and I'll show you the table. Otherwise, what else is there to say, as I've already mentioned? Chevron is indeed quality, but with a P/E ratio of 30, in my opinion, it's too expensive. And that's why I prefer to go for other stocks that aren't valued so highly. Of course, I have to live with the fact that the volatility might be a bit higher, but in my opinion, that doesn't bother me. I'm, let's just say, finally used to fluctuations. And once you know how the whole thing works, it really doesn't give you any concerns, so to speak. What else do we have? Yeah, I think that's pretty much it. That would simply be the comment stream series that I've now gone through completely with you. There were a total of 25 to 26 stocks, so to speak. The next series will be about REITs and pharma. Rates and pharma. I'm alternating between them because I think focusing on just one block would be a bit boring for others who are also interested in REITs. And that way we always have a little bit of variety as well. As I said, this video is not investment advice, but simply my personal strategy. Feel free to let me know in the comments which stocks you currently prefer. And especially how I should handle all these quarterly reports. Should I write an article about them on my website? Or would you prefer to sign up for a newsletter where you get a bit of analysis or a summary with the most important information? You just have to let me know. Just leave a quick comment below, and then I'll know and I'll set it up for you. And yes, otherwise, the current status of this video is April 2026. As always, I wish you successful investing. I'll see you in the next video.